If you were watching the global trading floors yesterday, you saw an overnight transition from cautious stability to an absolute flash of red. This isn't an isolated correction in one corner of the market. We are seeing a synchronized drop across different geographies and sectors as two separate pressures collide at once. European indexes closed firmly in the negative, with Germany's DAX shedding 1.1% by the end of the session. What makes this sell-off distinct is how it combines events. A specific geopolitical conflict and a growing fatigue regarding tech hardware have merged into a single global shock. The first shock is physical. The interim U.S.-Iran ceasefire has ended, following fresh airstrikes and the termination of the Memorandum of Understanding. This chart shows the immediate reaction in the energy market. Brent Crude spiked 5.6% following that news, pushing the price over $78 per barrel. The second shock is digital. After a period of heavy spending on AI infrastructure, investors are starting to look for near-term productivity returns that haven't yet materialized. That skepticism hit the Asian tech sector hard. South Korea's Kospi tumbled 5.4%, with chip giants Samsung and SK Hynix dragging the index down. When energy prices surge at the same moment tech valuations are under pressure, the typical safety nets for investors begin to thin out. Emerging markets are feeling the combined weight of these events, with India serving as a clear case study. This shows the squeeze on India's economy. The crude oil spike drives a rising import bill, compounding weak global tech cues. India's Nifty 50 dropped over 2%. Simultaneously, the India VIX surged nearly 30%, reflecting extreme market uncertainty. There is also a currency effect. As demand for the US dollar increased as a safe haven, the Indian rupee depreciated by 59 paise, closing at $95.55. These combined pressures show how emerging economies can be vulnerable when physical supply chains and digital investments face simultaneous disruptions. In response to these types of disruptions, some of the largest tech corporations are restructuring their supply chains. Apple has moved to secure its supply chain against the volatility currently seen in Asian markets and the Middle East. They have signed a multi-year $30 billion agreement with Broadcom to focus on domestic production. Under the American Manufacturing Program, this deal will fund a $1.5 billion expansion of a facility in Colorado to produce over 15 billion US-made wireless and radio frequency components. This is a shift away from reliance on globalized production and toward a domestic model designed to insulate a company's chip pipeline from international shocks. The surge in oil prices is now challenging the previous expectation of global interest rate cuts, as localized fears of renewed inflation return to the foreground. Market expectations for a U.S. Federal Reserve interest rate hike in September have now climbed above 67. This has led to a focus on securing domestic supply chains, a model that companies like Apple are now beginning to prioritize. The result is a move away from a fully open, interconnected market toward a model defined by distinct, regionalized blocks. The focus of the global market is shifting from rapid, borderless expansion toward a priority on securing supply lines against overlapping disruptions.